All right, still the Arise Exchange right here on Arise News. Recent global crises have exposed the vulnerabilities in the liquidity and resilience of various funding markets, in particular short-term funding markets, corporate bond and government bond markets. Now, key players at the global market leaders of issuers, investors, and others sat down for a discussion around this at the recent spring meetings in the IMF held in association with the International Organization of Securities Commissions, known as Imf-Iosco. There's an excerpt from the panel.
So right now, the state of the credit markets is it's pretty healthy. Like the spreads are tight, issuance is robust, M&A is robust. So when we talk about resilience and liquidity and the sustainability of markets, we're in a pretty good spot right now in terms of the credit markets. There's been a robust and healthy response to higher yields, and the demand for yields from our clients is pretty universal and high, and that, along with strong growth, has allowed spreads to tighten. And I like to always say that the resilience and health of a market within credit is driven by issuance and beta. And both of those boxes are pretty well checked right now in terms of primary issuance, companies being able to have access to capital, solutions being provided for companies that are healthy, and even companies that are struggling. And the demand for beta in both DM, developed markets and emerging markets is high. And you've seen a good healthy pivot, I would say, within EM away from China towards other beta countries, which has been nice to see the clients continue to look for different opportunities. And in DM, like we said, the growth rates are high, default rates are low. There's certainly companies that are struggling with higher for longer, companies whose capital structures were built for a lower yield environment, but the market is working through those and being able to kind of provide solutions. And we're talking low to worst case mid-single digits type of those companies. So it's all in all, I would say the state of the market is pretty resilient.
So 2008 was clearly all about credit. Go forward 10 years, and now we're seeing far more bouts of liquidity stress in the marketplace. So in the most extreme being in March 2020, when in the US, both primary markets, you're mentioning primary and secondary, primary markets closed down in the short-term funding markets, also secondary trading, and in Europe, there was very limited secondary trading in those markets. If we look, though, to secondary trading in corporate bond markets at that time, contrary to the beliefs of many, that trading actually held up compared to outstandings. But the prices that had to be paid, the spreads exploded. And we saw the same with US Treasuries. Moving on to the energy crisis post the Russia's invasion into Ukraine, we have seen vast multiples higher being asked by the CCPs in both VM and initial margin, which meant that energy companies had to overnight post considerably higher amounts of cash, with several companies going out of business. So if there's anyone, you were talking about what does it mean for companies and the sort of real economy impact, that is, I don't think you can get a more stark sort of illustration of the importance of funding markets. So very, very different causes over time, what's at play. And I think the key message I want to get across is that the reforms following the global financial crisis really made this system far more robust and resilient. But at the same time, it rewired those the markets, the ecosystem, and created new challenges and new frictions. So we saw central clearing and counterparty risks being addressed, and prudential reforms de-risked the banks and reduced their reliance on short-term funding. But that has basically hardwired in collateral to volatility in markets. If there's an exogenous stress event, investors have to find more cash. And at the same time, banks are not able to intermediate and move cash through the system at the same time.
So from a market regulator's point of view, maybe very quickly, two levels of preoccupation and intervention. First of all, the the general good functioning of markets, and that is not the major point today, but still it's our main mandate. And secondly, the financial stability risks that we see emerging from evolving market structures. So maybe one quick point about the good functioning of the markets, because basically what we want as regulators is for market to provide the good funding, we are talking about funding markets, at the right moment to the right people in the right conditions. That means two things. First of all, that they are working smoothly, and also that we have fair information and we have a good level of investors' protection on the markets, but also that we have the right financing for the economies and firms that are coming to the markets, and governments, by the way, to get funding. So that is one of the reasons, and I'm coming to your question, what do we see, what are the differences between the US markets and the European markets? I will obviously focus on European situation because, well, I'm a regulator in Europe, first of all, and I know that better. And the situation in Europe is that we have basically, and to make things very fast, underdeveloped capital markets compared to the US. And well, there are many reasons for that. We won't have time to get into this today, but this is the reason why we see a relaunch of a very important project for the European markets, which is the Capital Market Union project that will be discussed by our heads of state no later than this week in Europe. And the reason for that is that, well, to put it very simply, we need more money.